Hello students and welcome to the lecture. So students, as we know that we are covering the financial system, and basically what we are doing, we are covering the non-banking finance companies. Okay, we are covering this topic into this particular series. All right, these are the topics we have scheduled for the discussion, like the introduction, credit intermediation, asset financing, housing finance, microfinance, investment and the wealth management, infrastructure finance, and the conclusion. Okay, these are the topics we have scheduled for the discussion. Okay, out of this, we have covered the introduction, credit intermediation, asset financing. We were discussing the housing finance. All right, and the topics we are left with microfinance, investment and wealth management, infrastructure finance, conclusion. Okay, so this is the picture we have created together so far. Okay, I hope that you have revised the housing finance lecture in the well enough manner before you have come for this lecture, because in that lecture we have talked about housing for all initiative. Okay, so now just you can say put a quick check whether you have revised this or not. Tell me the alternate name of housing for all initiatives. Just tell me the alternate name of it. Okay, you have 10 seconds to think, then I will tell you the answer. Your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Time's up. So basically the scheme of housing for all, also known as PMAY. Okay, and the PMAY known as Pradhan Mantri Awas Yojana. Okay, many places some students claim that it is known as Prime Minister Awas Yojana. Okay, but this is wrong and this is right. PMAY full form is Pradhan Mantri Awas Yojana, not Prime Minister Awas Yojana. Okay, and you could even check it by a common sense also. Like if we talk about Awas Yojana are the Hindi words. Okay, so if the half name is in Hindi, it means the another half name will be also in Hindi, not in the English. Pradhan Mantri in Hindi we call it as a Pradhan Mantri. Sorry, Prime Minister in Hindi we call it him as a Pradhan Mantri. Okay, so by this you could also get your answer. Now let's start with the topic we had covered in the previous lecture and we had left also. Diverse funding sources. NBFCs often have a diverse range of funding sources, including the bank loans, debentures, commercial papers, and external commercial borrowings, allowing them to offer competitive lending rates. Okay, now, like if we talk about the traditional banks. Okay, and if we talk about NBFC, what is common in them? What is common? Basically, in the traditional banks, okay, they have the capital plus deposits. Okay, so they use it for the lending purposes, right? Okay, but when we talk about the NBFC, okay, so we know that NBFC does not having any rights to accept the deposits. So it means that they are totally depend upon the capital they have for the lending purposes. right? This is the scenario. Traditional banks and the NBFC. Okay, so right now you could see here that this is the capital. All right, so you can say traditional banks get the support of the deposited amount so that their capital is huge in terms of the comparison with the NBFC capital, because they do not having any support from the deposits. So that's why they are totally rely on the capital. Okay, and to raise this capital, they having various ways like the bank loans, like the debentures, like the commercial papers, like the external commercial borrowings. Okay, so what we will do, we will you can say try to understand them one by one after the example. First, let's take an example of bank loans. Bank loans. Okay, so bank loans are generally, you can say, or basically referred to as a refinance. Okay, refinance, you can say, suppose these are the borrowers who have taken a loan. Okay, thereafter these are the borrowers who haven't taken a loan. Two situations here. Okay, this is the NBFC. All right, so suppose the NBFC has provided the credit to the borrowers who have taken a loan. What this will do with their capital? This will decrease their capital. Okay, and NBFC has the responsibility for these borrowers also, but their capital is on decline because they had granted the loans to these borrowers, and these borrowers will repay the amount after a certain period of time. Till that completion, they are in the condition of deficit from the capital. So in such a you can say cases, the traditional ways, I'm not going to represent any bank, any financial institution. Instead of this, I'm just writing down traditional ways. Okay, then these traditional ways basically provide the refinance to the NBFC so that they could maintain the capital reserve. Okay, they could maintain the capital reserve so that they could also discharge their liability to the borrowers. Okay, so that's how they raise their capital from the bank loans, because this refinance, okay, the amount which they have taken as a refinance is supposed to be pay back to the traditional ways after a certain period of time. Okay, so that's why they are known as the bank loans. Thereafter, second term is the debentures. Okay, but before debentures, let me understand the commercial papers and the external commercial borrowings. Then we will talk about debentures, because in the case of debentures, we have to also talk about the shares. Okay, because this is very you can say basic thing to understand. So there is nothing like a rocket science. So commercial papers. Okay, second is our commercial papers. Okay, so commercial paper is same like the government bonds. Why we are seeing this same like the government bonds? Because suppose this is the NBFC. Okay, NBFC. All right, it has issued the bond for 10 years and the bond price is 10 crores, at which the promised interest rate is 5% per annum. Okay, this means that the buyer of this particular bond will receive 10 crores 5% means 50 lakhs per annum up to how many years? Up to 10 years. Okay. So this is same like the government bonds, in which the government issues the bond for certain period of time with certain value with fixed interest. Okay. But when it's come to the private sector, it's known as the commercial papers. Okay. But remember, it is risky in comparison with government bonds. Why? Because government bonds are generally backed by the government. So there are no chances of getting defaulted. But when we talk about the commercial papers are basically backed by the private sector. So there are chances that might be the NBFC, which had issues that particular commercial paper, will be defaulted. Okay. So that's why the buyer maybe he will be debarred from promises made to him. All right. This is the commercial papers. Okay. Bank loans, commercial papers. Third is external commercial borrowings. Okay. So what do we mean by external commercial borrowings? What is the meaning of them? Basically, it's mean raising a money from issuing commercial papers for foreign currency. Okay, this is known as the external commercial borrowing. For example, suppose this is an NBFC. Okay, right now they want you can say 80 into 50. Okay, 1000. They want 40,000 or 40,000 crores. Okay, they want 40,000 crores, but they do not want to get them in the Indian rupees. Okay, so what they will do? They will issue 80 million USD. Okay, this might be changed because it's totally depend upon the conversion rate. So here just I am giving you the example. All right, it means that the amount they want is in the denomination of rupees, means 40,000 crores. Okay, but amount in which they are issuing the commercial paper is in the foreign currency. Okay, so whenever a company which is registered in India is issuing the commercial papers for the investor outside of India, because here the international investors or you can say the American investors will be invited to put the money in the NBFC. Okay, because right now it is in the US dollars, which is the currency of America. All right, and you can say even it is an international currency. So now I hope that it is become clear to you the bank loans, the commercial papers, now the external commercial borrowings. Okay, here the fourth point is debenture. Okay, and with debentures there is shares also. So what is the difference between the debentures and the shares? This is we are required to understand. Okay, like what do you mean by the debentures? What do you mean by the shares? Okay, so debentures is basically kind of bond in which principal amount along with interest returned to buyer after a certain period of time. Okay, this is the debenture, kind of a bond in which principal amount along with interest returned to the buyer after a certain period of time. Whereas when we talk about the shares, kind of equity, or you can say asset, in which amount paid to seller and buyer become eligible for holding ownership or getting fixed interest rate. Okay, so shares is a kind of equity or the asset in which amount paid to the seller, it is a seller, and buyer become eligible for holding ownership or getting fixed interest rate. Okay, so now let's take an example of debenture. Okay, so debentures is a bond, kind of bond. For example, suppose this is the debenture, okay, which is worth rupees 10,000. Okay, promise interest is 10%. Duration is 10 months. Okay, going by this, what will happen that suppose the debenture was purchased in the January, it is a first month. Okay, in October, which is the 10th month. Okay, so in the 10th month, as per the definition, that return to buyer after a certain period of time, principal along with interest. So you can say in the 10th month, the buyer will get how many rupees or how many amount back? It will receive rupees 11,000. Okay, in which 10,000 was the principal amount, okay, and the additional rupees 1,000 is the interest. Okay, so it means instead of getting the interest on the regular basis or monthly, the buyer who had buy this debenture in the month of January will get rupees 10,000 plus 1,000 as an interest in the 10th month, or you can say in the October. This is the debenture. Okay, but if we talk about the share, then shares is a kind of equity or asset in which amount paid to the seller and buyer become eligible for holding ownership or getting fixed interest rate. Okay, so basically you could say, like when we talk about the shares, so there are two types of shares. Basically, equity preference. Okay, so if we talk about them one by one, equity shares provides ownership, gives rights in company. Okay, third, interest or dividend not fixed. Fourth is tentative. What is tentative? Or you can say risky in comparison. Okay, while we talk about preference shares, not provide ownership, okay, not gives right in company, rights in company. Third, interest rate is fixed. Fourth, less risky in comparison. Okay, so this is just a points. Now we are required to understand them. So whenever the company issues the shares, okay, in the market, basically they have to highlight that whether the shares are of the equity or of the preference. Okay, so when we talk about the equity shares are basically those shares which provides the ownership. Okay, it means that suppose this is a company called XYZ. Total worth of XYZ is 100 crores. Okay, so they issue 100 shares at rupees 1 crore each. Okay, so suppose if the buyer purchase 25 shares out of these 100 shares, it means that how much amount he will have to pay? He is required to pay 25 crores against the shares he has purchased or holding. Okay, 100 shares is the 100% wealth of the company. Out of 100 shares, 25%, it means that the equity will be how much? Will be 25%. So the buyer is owner of 25% stake. Okay, just write down again. If this is a company called the XYZ, all right. Right now, suppose 100 shares they have launched at rupees 1 crore each. Okay, and the buyer had purchased 25% shares. Okay, or 25 shares. Total wealth is 100 crores. Okay, so it means that how much amount he is required to pay? He is required to pay 25 crores. Okay, so total amount he has paid 25 crores. Okay, so this 25% shares and 100 shares means that 25 is a 25% of the 100. It means total equity will be how much? Will be 25%. Okay, so the buyer become owner of 25% stakes in the XYZ. Okay, so that's how the equity share works. All right, but when we talk about the non-equity also we call it as a preference shares. When we talk about them, okay, so we know that they do not provide any ownership or equity. All right. For example, suppose this is the company XYZ. Okay. XYZ required rupees 100 crores. Okay. So they had launched 100 shares at 1 crore each. Okay. On which they had promised that they will provide 10% interest rate on the fixed basis. So if the buyer holds 25 shares, it means that he will receive 25, or you can say he will receive 10% of 25 crores. Why? Because each share was at 1 crore rupees, 25 shares, 25 into 1 is equal to 25. Okay. So he will receive rupees 2 crores 50 lakhs or 2.5 crores as a interest on the fixed basis. So this is the actual difference between the equity shares and the non-equity shares. While the equity shares providing the ownership in the company, non-equity share does not provide any ownership of the company. Okay. Equity shares is basically, you can say, does not having any fixed return. It means that by purchasing the equity shares, you become the part of the company and you are equally liable to suffer the profit or loss of the organization. If the organization is the profit, you will also get the benefit of it. If the organization is in the loss, you will also suffer a little bit. Okay. But this situation is not there in the non-equity or the preference share. Doesn't matter whether the organization is in the profit or loss. Doesn't matter. You will receive your fixed amount. Okay, because you are not holding any ownership, you are not a part of the organization by anyhow. Okay, but you have invested your money, so that's why you will get a return of it. Okay, so basically, non-preference shares, preference shares or non-equity shares, they are generally of the three types. What three types? Okay, first is the non-convertible. Okay, second are the optionally convertible, and then the partially convertible. Okay, so non-convertible are those which couldn't be converted into equity shares. Okay, optionally are which could be converted into equity shares. All right, if the investor want to it. Partially converted means some portion is non-convertible or fixed, some is convertible or equity. Okay, for example, if the buyer has invested rupees 25 crores because he has purchased 25 shares. Okay, so for example, out of this 10 shares are non-convertible or NC. The rest 15 are PC, partially convertible. Okay, so he will receive fixed interest on 10%, but tentative interest as per the, you can say, performance of the company on these 15% shares. Okay, so that's how the system works. So students, basically in this lecture, we have seen this diverse funding sources. Okay, in the next lecture, we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for another lecture. With this note, let's end this lecture, and what we say, thank you.